Investing is full of myths. Many people believe these myths and make poor decisions. Did you know that 75% of day traders lose money? Or that the average investor earns less than inflation due to bad timing? These are shocking facts. In this video, we will debunk the biggest myths about investing. You will learn why you don't need to be a millionaire to start investing. We will show you that the stock market isn't just like gambling. And we will reveal why market timing isn't the key to success. Our goal is to give you clear, simple strategies. We want you to invest wisely and avoid common pitfalls. So, are you ready to uncover the truth about investing myths? Let's dive in. Chapter 1. Quick Riches, the Overnight Success Illusion. Many people think that investing is a quick way to get rich. But this is far from the truth. Investing is a long-term game. Warren Buffett, one of the world's richest investors, often says, the stock market is a device for transferring money from the impatient to the patient. Patience is key. Did you know that the average annual return of the S&P 500 over the last 90 years is about 9.8%? This means if you invested $1,000 and let it grow without touching it, you could have a substantial amount in a few decades. One key strategy is to start early. The power of compounding is incredible. For example, if you start investing $200 a month at age 25, by the time you are 65, you could have around $500,000, assuming an average annual return of 7%. Starting late means missing out on years of growth. Another strategy is to reinvest your dividends. Instead of taking the cash, put it back into buying more shares. This helps your investment grow faster. Think of it as planting a tree and letting it grow without cutting branches. Diversifying your investments is also crucial. Don't put all your money in one stock or sector. Spread it across different types of investments like stocks, bonds, and real estate. This reduces your risk. For example, during the 2008 financial crisis, while stocks were plummeting, bonds provided some stability to portfolios. Many investors fall into the trap of chasing hot stocks. It's tempting to jump on the bandwagon of a stock that's skyrocketing. But this can be dangerous. Research from Dalbar shows that the average investor earns less than the market average due to poor timing decisions. Staying the course with a diversified portfolio often yields better results. Chapter 2. The stock market is just like gambling. Some people think investing in the stock market is like gambling. But they are very different. Gambling is based on luck, while investing is based on research and strategy. Peter Lynch, a famous investor, once said, "Know what you own, and know why you own it." This means understanding your investments. One key difference is the role of time. In gambling, the longer you play, the more likely you are to lose. In investing, time is your ally. Historical data shows that the longer you stay invested, the more likely you are to see positive returns. For instance, the S&P 500 has never had a losing 20-year period. Research is another big difference. In gambling, you can't research the outcome of a roll of dice or a spin of a wheel. But in investing, you can study companies, read financial reports, and analyze market trends. This information helps you make informed decisions. Another strategy is to focus on value investing. This means buying stocks that are undervalued by the market. Warren Buffett is a big proponent of this strategy. He looks for companies with strong fundamentals that are selling for less than their intrinsic value. Diversification also plays a role here. In gambling, you bet all your money on one outcome. In investing, you spread your risk. By holding a mix of assets, you reduce the impact of any one investment's poor performance. For example, during the dot-com bubble burst, many tech stocks crashed, but diversified portfolios fared better. Chapter 3. You need a fortune to start investing. A common myth is that you need a lot of money to start investing. But this isn't true. You can start with small amounts. Many investment platforms allow you to start with just $50. Over time, these small amounts can grow significantly. One great strategy is dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of the market conditions. This strategy helps reduce the impact of market volatility. For example, if you invest $100 every month, you'll buy more shares when prices are low and fewer when prices are high. Another option is to invest in exchange-traded funds, ETFs. These funds hold a basket of stocks, bonds, or other assets. They offer diversification at a low cost. Vanguard's Total Stock Market ETF, for example, provides exposure to the entire U.S. stock market for a low expense ratio. Robo-advisors are also a good choice for beginners. These automated platforms create and manage a diversified portfolio for you based on your risk tolerance and goals. Companies like Betterment and Wealthfront offer these services with low minimum investments. It's also important to take advantage of retirement accounts like 401ks and IRAs. These accounts offer tax benefits that can help your money grow faster. If your employer offers a match on your 401k contributions, make sure to contribute enough to get the full match. It's like getting free money. Chapter 4. Only experts can succeed in investing. A lot of people think only experts can make money in the stock market. But this isn't true. You don't need a finance degree to invest successfully. Warren Buffett, one of the most successful investors, says, "Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. It's about patience, discipline, and some basic knowledge." One strategy is to start with index funds. These funds track a market index, like the S&P 500, and provide broad market exposure. They are simple and have low fees. Over the long term, many index funds have outperformed actively managed funds. Another approach is to use a buy and hold strategy. This means buying stocks and holding them for a long time. Research shows that this strategy often yields better results than trying to time the market. A study by Fidelity found that their best performing accounts were those where investors forgot they had an account. Reading and learning are also key. There are many great books on investing, like The Intelligent Investor by Benjamin Graham. This book has timeless advice on value investing. Another good read is A Random Walk Down Wall Street by Burton G. Malkiel, which explains the benefits of a diversified portfolio. Using tools and resources available online can also help. Websites like Morningstar and Yahoo Finance provide valuable information about stocks and funds. These tools can help you make informed decisions without being an expert. Don't overlook the power of automated investing services, or robo-advisors. These platforms use algorithms to create and manage your portfolio based on your goals and risk tolerance. Companies like Betterment and Wealthfront make investing accessible for everyone. Chapter 5. All debt is bad debt. Many believe that all debt is harmful. But not all debt is created equal. Some debt can be good if used wisely. For example, taking out a mortgage to buy a home can be a good investment. Real estate often appreciates in value over time, and owning a home builds equity. One strategy is to use leverage to boost your investments. This means borrowing money to invest, which can amplify your returns. However, it's important to be cautious and not over-leverage. The key is to ensure the returns from your investments exceed the cost of borrowing. Another approach is to use debt to finance education. Investing in yourself through education can lead to higher income and better job opportunities. According to the U.S. Bureau of Labor Statistics, workers with a bachelor's degree earn about 65% more than those with only a high school diploma. Debt consolidation can also be a smart move. This involves combining multiple debts into a single loan with a lower interest rate. It simplifies your payments and can save you money on interest. However, it's important to avoid accumulating more debt after consolidating. It's also worth considering debt in the context of business investments. Many successful entrepreneurs have used debt to start or grow their businesses. For instance, Jeff Bezos took on debt to help fund Amazon in its early days. Today, it's one of the most valuable companies in the world. Chapter 6. High risk always means high reward. It's a common belief that high risk always equals high reward. But this isn't always true. While some high-risk investments can yield high returns, they can also lead to significant losses. Understanding the balance between risk and reward is crucial for successful investing. One strategy is to assess your risk tolerance. This means understanding how much risk you're comfortable taking. Younger investors might afford to take more risks because they have time to recover from losses. Older investors, close to retirement, might prefer safer investments. Diversification is a key strategy to manage risk. By spreading your investments across different asset classes, you reduce the impact of any one investment's poor performance. A diversified portfolio can include stocks, bonds, real estate, and commodities. This mix can help balance risk and reward. Another important concept is the risk-adjusted return. This measures how much return you're getting for the risk you're taking. Investments like bonds might offer lower returns than stocks, but they also come with less risk. Balancing these can lead to more stable returns. Understanding market cycles can also help. Markets go through cycles of growth and decline. Recognizing these patterns can help you make informed decisions. For example, during a bull market, high-risk investments might perform well. But in a bear market, safer investments might be better. It's also useful to consider alternative investments. These can include things like private equity, hedge funds, or real estate. These investments can provide good returns and diversification. However, they can also come with higher fees and less liquidity. Chapter 7. You have to constantly buy and sell to win. Many people think they need to constantly buy and sell to make money in the stock market. But this can lead to poor decisions and high costs. Frequent trading can eat into your returns due to transaction fees and taxes. Peter Lynch once said, "The real key to making money in stocks is not to get scared out of them." Holding your investments for the long term can often be more profitable. One key strategy is to invest in companies with strong fundamentals. Look for companies with consistent earnings growth, strong cash flow, and a solid balance sheet. These companies are likely to perform well over time, reducing the need for frequent trading. Another approach is to set clear investment goals. Decide what you're investing for, whether it's retirement, a down payment on a house, or your child's education. Having clear goals can help you stay focused and avoid impulsive trading decisions. Use a buy and hold strategy. This means buying stocks and holding them for a long period, regardless of short-term market fluctuations. Historically, this strategy has outperformed frequent trading. For example, if you had invested $1,000 in the S&P 500 in 1980 and held it until 2020, it would be worth over $73,000 today. Consider using dollar cost averaging. This involves investing a fixed amount of money at regular intervals. This strategy reduces the impact of market volatility and avoids the pitfalls of trying to time the market. Even Warren Buffett advocates for this approach for most investors. Investing in index funds or ETFs is also beneficial. These funds provide broad market exposure and are designed to match the performance of a specific index. They require little maintenance and are a good option for investors who don't want to constantly monitor the market. Chapter 8. Market timing is the key to success. Many believe that timing the market is the key to success. But trying to predict market movements is incredibly difficult. Even professional investors often fail at it. A study by Dalbar found that over a 20-year period, the average investor earned a return of 2.6%, while the S&P 500 returned 7.2%. This is largely due to poor market timing. One strategy is to focus on time in the market, not timing the market. The longer you stay invested, the more likely you are to see positive returns. For instance, the S&P 500 has never had a losing 20-year period. Staying invested through market ups and downs can yield better results than trying to time your entry and exit points. Consider a buy and hold strategy. This involves buying stocks and holding them for the long term. It's based on the idea that markets tend to rise over time, despite short-term volatility. Research shows that holding investments for the long term can significantly increase your chances of success. Another approach is to use dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps reduce the impact of market volatility and removes the guesswork of trying to time the market. Diversification is also crucial. By spreading your investments across different asset classes, you reduce the risk of significant losses. A diversified portfolio can include stocks, bonds, real estate, and other assets. This mix can help balance risk and reward. Chapter 9. Real estate is always a safe bet. Many people believe that real estate is a guaranteed safe investment. But this isn't always true. While real estate can be a good investment, it also comes with risks. The 2008 financial crisis showed how real estate values can plummet. Understanding these risks is crucial for successful investing. One strategy is to thoroughly research the real estate market before investing. Look at factors like location, market trends, and economic conditions. Properties in growing areas with strong job markets are likely to appreciate in value. Another approach is to diversify within real estate. Don't put all your money into one property. Consider investing in different types of properties, such as residential, commercial, and rental properties. This diversification can help reduce risk. Consider using real estate investment trusts, REITs. These are companies that own and manage income-producing real estate. REITs offer a way to invest in real estate without having to buy and manage properties yourself. They also provide liquidity, as they can be bought and sold like stocks. Leverage can also be a powerful tool in real estate investing. This means using borrowed money to finance your investments. While leverage can amplify your returns, it also increases your risk. It's important to use leverage wisely and not overextend yourself. Another strategy is to focus on cash flow. Properties that generate positive cash flow can provide a steady income stream. This can help cover your mortgage payments and other expenses, reducing your financial risk.